Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, April 9th, and then we'll see how things look for Wednesday, April 10th. Wednesday is kind of the day the market's been waiting for. We're going to get CPI, which will come out about an hour before the market opens. Later in the day, we're going to get the meeting minutes from the last Fed meeting. If there's anything new in there, the market will react to that, but it may just be things that are already known and the market's already dealt with. Later in the week, we're going to get PPI. Now, when you take a bigger picture look at the market, we're still positive and we're showing good momentum. But in the short term and even into the intermediate term, the market could be looking vulnerable right now. We are starting to drift more to the negative side, but that could be taken care of with a good solid update. If the market doesn't like what CPI comes out with, that could shift things back more negative. So let's go back and talk about what happened. Right at the open, we had a higher open and prices climbed above R1 at 52.16. Then we declined, so we shifted. We went down below the daily pivot at 52.06. We went negative by dropping below the unchanged level. Then we dropped below 5,200. We came down to S1 at 51.93, S2 at 51.84. We finally found support at S3 at 51.60. As the day went on, we rebounded back above S2. We hit resistance at S1, and then we chopped around. We went back and fell below S2 again. There was some late day buying that came in. We were able to climb back above S2, S1, the unchanged level, the daily pivot, and we ended up closing slightly higher. For most of the session, it was looking more negative. It was near the end of the day when we saw this real upward move coming into the market. We were up 0.14%, not a real huge move, but we're still below average with volume. We've seen that in Monday's session, Tuesday's session. We saw it pretty much all last week, except for Thursday when we had the decline. The week before that was a holiday shortened week. We were below average then. So when you take a look at the big picture, we're still looking okay. But when you start to break down the short and intermediate term, the market's pretty apprehensive right now. We are positive with our technicals. It's all about inflation and interest rates in Wednesday's session. What is CPI going to say? If it comes in hot, that could really put some pressure on the markets. If it comes in under expectations, that could really produce an upward move. Probably what will happen is there'll be a mix in somewhere in the overall report, and it'll leave the markets more confused rather than having any real conviction. And then we also want to keep an eye on all the different geopolitical events. Here's some comments. The market is awaiting CPI. That's the big thing for right now. The broad market did outperform in Tuesday's session. We saw the mega caps pulling back a bit. Oil did decline. It's now at 85.30 or $85.30. And it has been coming down the last couple of sessions, but before that, it's really been shooting up, and that's been putting some pressure on stocks. In the long term, we just have our 150 and 200 simple moving average. Now, with the upward move that we saw, we kicked our exponential moving average based on 200 periods. That's now looking extreme positive. But these are longer term. And the parabolic SAR still remains negative. We're wondering if there's going to be a change to the current scenario, that the Fed is likely done raising rates, looks to cut rates possibly 3 times in 2024. Will that be adjusted with the CPI that comes out in Wednesday's session? The dollar was down and interest rates were down. This gave some support to stocks. We're still kind of high with the 10-year yield compared to where we've been, but we closed at 4.37% for the 10-year yield. We're still inverted with the yield curves. Sentiment actually ticked down because we spent a lot of the day being negative. It's still positive at 61, where it had been at 66. We're not trending right now. Both our short and intermediate term ADX indicators have dropped below 20. That's a static level. When we drop below that, that just means that the market is not in any kind of trending fashion. And we're still below the moving averages. So it doesn't show that we're going to switch over back into a trending environment. But we're also looking negative because the red lines are still on top. For right now, I'm keeping our bias at mixed. Yeah, we had the up day, but then we had the down day on Monday. And our momentum is also mixed going back over the last number of days as the market's trying to figure out where do we go from here. Economic reports. We just had the NFIB Small Business Optimism Index, and it came in down from the previous reading at 88.5. Last time it was at 89.4. Here's a chart showing how the optimism for small businesses is really trailing off so far in 2024. Is that going to do some damage to the economy? Most people work in small businesses, and if these businesses are not really happy about things, then people that work at these companies are probably not very happy about things either. Some charts that I found at IsabelNet, and this is a little blurry. I know that I try to blow up this bottom part as much as I can, but it makes it kind of fuzzy here. This is just saying yet another feather in the bull's cap. This is put out by Carson, and it's the performance after we've had a greater than 25% gain in a 100 trading days. And this just shows you, what does it look like going forward? 80% of the time we're up. 3 months we're up all the time. 6 months up 90%, as well as looking out a year into the future. So that bodes well. We had a good solid upward move during the first 100 trading days. So that usually bodes well going forward from here. But we might see some short-term bumpiness if there's not positive reaction to CPI. This also shows discretionary buybacks. Those driven by management discretion will decline temporarily over the next 2 to 3 months because they have this thing called a blackout period. And I have a definition of that. It's beginning 2 weeks prior to the end of the quarter, and then 48 hours after that company releases their earnings. They can't announce or do any buybacks during that time. Buybacks are a huge support for the market. It comes in and buys back their own company stock. The buying pushes prices up. The company takes those shares. That means there are fewer shares on the market, which makes them more precious if you're into Lord of the Rings and The Hobbit. And that can really help put some support under the prices for those particular companies. Well, we're seeing this starting to drop off now. And so because we're coming into earnings season, they're not doing that right now. And so the support that this could be giving the market may be temporarily going away for a while. And gold, everybody's talking about that. The gold bugs who've been saying for decades now that gold's just going to break out and go to the moon. And now they're saying, well, see, I told you all along this was going to happen. Well, they were saying this 10 years ago, and as gold was not performing all that well. But this is just a technical chart showing how gold is looking pretty good going up here. Bull flag, I'm not into these different patterns. Above its 200-week simple moving average. We do have some different projections as far as Fibonacci lines are concerned as to what could happen going forward, also showing that the momentum is positive. And the RSI, though, it's looking a little extreme. It's because a lot of people have been getting into gold lately. Then I did find a few charts on Twitter. This is the macro hedge funds. Now, hedge funds, as I usually explain, these are big, they're like mutual funds, but they usually have some magical way of investing in the market. They hire maybe a manager or something that's supposed to have all this insight that nobody else has. They charge a lot more fees. A lot of really wealthy people like to get into these because they're looking for good returns. And so a lot of these hedge funds, some of them do quite well, and some of their managers become quite famous. Well, others don't do as well. And even though they may have a lot of money, they're not necessarily considered to be the smart money. Right now, it's just showing that we're getting a really high reading now with their exposure to stocks in the US. And when we've had other really high readings like that, usually we would turn and go down from here. So just something to be aware of on a longer term basis. And then this chart is something I ran across. This is put out by Goldman Sachs. It's called the Panic Index. And we're getting kind of a high reading right now. The last time we had a really high reading like this was back in October, and that's when we hit a bottom. Then if you take when we hit the top last July or August of 2023, we were getting a pretty low reading during that time. So this would suggest that this high reading, meaning according to how they measure things here, that they're panicking a little bit, and this could actually be positive for the market. And we're also keeping an eye on the cycles. We're coming into the 10th now, where maybe we've topped out for the number of days here. According to this, we might see a decline starting on about the 10th, going into about the 24th of April. I don't know if there's anything to this or if it's just hocus pocus voodoo, but we've kind of been following along with what these cycles have been saying. Here's our intraday chart. We had a higher open. It was looking pretty good right off the bat, but then we saw some selling into strength, took us down below the daily pivot. We dropped below the unchanged level, a pretty big wave. It might have been some kind of a sell program. There was really no news that drove this down. We fell below S1, S2. We finally found support at around S3, bounced up off of that, came all the way back up to S1, then dropped back down below S2. And then we saw some late day strength, which was able to take us back positive. Here's our intraday chart, where we were pretty much flat in the initial overnight session, chopping around before the market opened, but turning more positive. Here's the cash session, and we're just slightly positive as we enter into the initial overnight session. There's a real wait and see mode going on right now until CPI comes out. When we look at our intraday growth of value, we are still looking a little bit better with the blue line above the red line. So this is showing some improvement here. And we ticked up just a little bit near the end of the day, but we're still dropping back when we look at our S&P growth to value ratio. So we were showing some improvement. Now this is starting to fall back, but we did see a little surge as buying came into the market. Our end of day charts, growth was unchanged where value was up. Growth was down for the mid caps where it was up for value. And it was up, but up quite a bit less for the small caps. So we saw value really outperforming growth in Tuesday's session. And we're seeing that kind of reflected here with our end of day charts, where we're still dropping off, even though it ticked up a little bit with small cap growth to value. We were flat with mid cap growth to value, and we declined with S&P growth to value. Discretionary, it ticked down just a little bit. Longer term, it's still in an uptrend. We're waiting to see if this can break out and continue to go to the upside, but that's just not happening right now. Large cap growth taken all together is still holding up. It was virtually unchanged. It was up 0.1%, but it's still above all of these plotted moving averages and still looking solid when you take it by itself. Our trend with the ADX, we are dropping below 20. We're at 19.63 right now. That means that we're going into a trendless environment or a non-trending environment, however you want to say that. The red line is going up and it's on top. So we would default to negative with our trend, but we're not in a trend right now. If this turns and starts to go back up and cross above 20, at that point, we would go back into a trending environment. If you're a little more aggressive with this, you might actually suggest that we're going back into a trend when we cross above the moving average. So there's different ways that you can interpret this indicator. We're also dropping off with our short term. We're below the moving average and the red line is on top. So we would default to negative. We're continuing to drop off when it comes to volume. And then sentiment, this has not been updated yet. Hopefully it will be updated for tomorrow's video. The last reading was very extreme at 4.43. We don't see readings that high very often. And so this could put some pressure on the markets. The Ulcer Index is starting to come to life a little bit, but we're still under the moving average, showing that fear is going up slightly. We came down with the VIX when we look at the line chart and the bar chart, and volatility ended up dropping off, but we're still above the moving averages with the bar chart and the line chart. But the momentum of the VIX is continuing to go up as folks are getting a little more fearful. We went up with the equity put call ratio, possibly some hedging going on ahead of the CPI coming out. And we're continuing to go up with our 5 period. This is also more negative for the market. The volatility risk premium also turned back up and we're above this band here, just showing that there's more risk coming into the market. When we look at our advanced decline line studies, we were up based on price and volume, and we're still holding up okay here. We're above the moving averages for right now. We're still trailing off with our new highs, new lows, and it's because we're seeing a decrease in the new highs, not so much an expansion of new lows. We're also declining with our 10-period moving average. We're still above zero and going back up with the advanced decline ratio. So this is remaining positive. Accumulation distribution is right back up to its moving average now. So it's at a tipping point again. We fell a little bit below it. With the late day surge that we saw, we came right back up to the moving average. We're still looking more negative here, but starting to chop sideways with the Chaikin money flow. But we saw a negative divergence as the S&P was going up, the Chaikin money flow was going down, and now we're actually turning more negative. Is this some kind of a basing pattern before it gets set to go back up, or are we going to see further weakness? Chaikin oscillator ticked up a little bit, but it's still below zero, so that's negative. Not a big change here with our advanced decline line studies. We were up with the NYSE common stock, S&P, mid caps, and small caps. So we saw a little bit of a bounce there. The broader market actually held up better. So that's keeping some of our bigger measures looking internally, still looking more positive. Here's our daily chart. We're above the pivot point right now. So the market is still pretty much at a tipping point. We were a little bit below it. Now we're a little bit above it. Are we going to bounce and go up from here or end up falling? If we do fall, we'll be watching the 50-period moving average. We continue to drop off as far as volume. We're also watching the 20-period moving averages. We are still above this, and we were able to recapture this last Friday, and the last two closes have been above the moving averages. If we lose this and look to close below this, that will turn the short term more negative. And then our open, high, low, close study based on 20 periods, we're still at the upper end of this mini rainbow. So far this support is holding, but that could change. We want to keep an eye on the 50-period moving average. If we see more weakness, will we be coming down to this level? We also look at the double and triple exponential moving averages based on 20 periods. We're dropping below. The lines are starting to roll over. A good solid day could change that. This could also portend to more weakness coming in the short term. We're able to go back up slightly with our 20-period exponential moving average and our 50, but we're starting to get a little extreme again with the 200. Now, this is also taken in a positive way where you could just say this is showing good long-term momentum. The force index is just a little bit positive right now, so it's pretty much at a tipping point as well. And we're not extreme with the short, intermediate, and long-term with our stochastics chart, which is strange. Usually it's one of those staples that we see in every video. And we're above the midpoint when we look at the standard deviations chart. So that gives it a little bit of a positive slant. Intermediate term, we are declining with the balance of power. This is turning a little bit more negative. We're still positive with the go, no go with the darker blue bars. We're still above the midpoint with our highest high value. We are trailing off with the TTM squeeze. So you can see the contradictions that we're seeing here with our indicators. Here's the 50-period double and triple exponential moving averages. After the big down move that we saw, you can see all the bars here have pretty much been chopping sideways. The red line is coming down, but it has not quite crossed below the blue line. If it drops below, that would suggest some weakness coming into the intermediate term trend. The Bollinger Bands were still above the midpoint here, so that's slightly positive. The ease of movement is declining and just barely positive for right now. We're still flat with the Arun indicator, so we're not getting much there. We ticked up a bit with the S&P McClellan oscillator, but we're still below zero. So we are declining based on price as well as volume. So this is turning more intermediate to longer term intermediate term, more negative. And when we look at the broader market, the NYSE McClellan oscillator, we did come up, but we're still below zero. So we are declining based on price as well as volume. We did turn up with the Swenlin trading oscillator based on price and volume, but they're still below zero. So they're still negative, but showing some improvement. And here's where we're seeing pretty much the same thing on different time frames. The PMO is now dropping down below its moving average. We're also declining based on price and volume. Although we saw a bit of an improvement with the PMOs that are rising, a bit of a turn up with the buy signals, we're still extreme positive with the PMOs above zero. And this could suggest longer term momentum because most PMOs are giving positive signs right now. We continue to be positive with the Elder's Impulse system for the S&P. We continue to be negative with the parabolic SAR system with the dots on top. When we look at our oscillators, we are trailing down, and I try to explain this, that part of this is due to how it's calculated. Since we're getting more of these flat numbers into the calculation, and we see a little bit of a downturn, and that kind of accentuates this downward move. We're also declining with the MACD, so all of our oscillators are declining in the short, intermediate, and long term. We're still hanging in there from a moving average basis, though. We're above this 20-period moving average. We're still looking more negative. We ticked up slightly with the bullish percent index, but I have a moving average on here as well that's continuing to decline. That's negative. And we ticked, just chopping sideways, but we ticked down slightly with the NYSE bullish percent index. This is more positive because it's above 50 and it hasn't really been declining all that much. We're turning back a little more positive with the NASDAQ 100 bullish percent index. We saw this go up and actually cross back above 50. So that's turning more positive. We're declining, but still above 50 with the money flow. We advanced, but we're still negative with the ultimate oscillator. And we're seeing this longer term weakness here with the vortex. Even though the green line's on top, it did decline on Tuesday. The RSI, when we look at the RSI 14, we're still above 50. We're also above 50 with the RSI 9. And most of the readings, in fact, all the readings for the 14 period have been above 50 in 2024. That suggests good momentum. We did see a few dips along the way with the RSI 9. That's a shorter term indicator that we use, but it is showing some improvement now. We're still above the moving average with on-balance volume. We're turning back and showing a little bit of improvement here with the stocks inside the S&P above their 20-period moving average. We also went up with those stocks above their 50-period moving average. And we're going back up with those stocks above their 100-period moving average and our 200-period moving average. So we did see some improvement here. But when we look at the Copic curve, we continue to be negative. The Sean trend meter is now declining and no longer extreme. Looking at the trend here, we're seeing more of a doji candle here with the Heiken Ashi. Not really moving up, not really moving down currently. The Kegi is still negative, but pointing up. So we're getting mixed signals. The Renko is still just happily going along, looking positive, where the 3-line break is now looking more negative. Longer term, we will keep an eye on this R1 level if we start to see some weakness at about the 5110 to 5111 level. Longer term, our 150 and 200 simple moving averages continue to be extreme positive. And pretty much for all of 2024, that's what we've been seeing. We did see a little bit of a dip down in February when the last CPI report came out. We're wondering, is something like that going to happen this time? We're still positive with the Keller market model across all the different time frames and all the different indexes. And then when we look at more of an intermarket analysis viewpoint, we're still declining with bonds based on price. We're still declining with commodities in the long term. We saw some positive, some negative, a lot of negative signals that were generated later on. But then when we bounced up, it didn't really generate anything positive. This was just a bounce that we saw near the end of the day. The equal weight and the S&P weighted index, they're pretty much holding up. We saw the weighted index or the equal weight index do a little bit better. And so we saw this ratio coming down slightly. We're not seeing any real move. If anything, it's kind of coming down as the mega caps have been more under pressure. The Dow is still at that tipping point. We're on the 50-period moving average. We're on this S1 level. So not much has been decided there. We switched from being negative to neutral with the diamonds for the Elder's Impulse system, and not a big change here. We were up slightly with the NASDAQ. We're just a little bit above this pivot point. We're still above the 50-period moving average. We were also up with the NASDAQ 100, coming back up a little bit above this pivot point and also above the 50-period moving average. We've turned over to positive with the QQQs when looking at the Elder's Impulse system, but the momentum for the NASDAQ 100 continues to be negative. We're still above the 20-period moving average here with the QQQs. So short term is holding up for right now. If we see some weakness, we'll be watching the 50-period moving average. Small caps were up a little over 0.5%, but really been chopping around, not going too much of anywhere. They're now kind of at a tipping point where we came back up to this pivot point after Tuesday. And they've remained positive with the small caps when looking at the Elder's Impulse system. We're still above 50 with the RSI. When we look at the Russell 2000 small caps, the longer term trend is positive and prices above both of the moving averages, but the momentum continues to be negative in the shorter term. The mid caps were up slightly and above this pivot point and above both moving averages here. The red line is above the green line, so that's still an uptrend. and they continue to be positive with the Elder's Impulse system when looking at the mid caps. Apple was up almost 0.75%, but continues to be in a downtrend. Tesla was up 2.25%, but also in a downtrend. And Nvidia pulled back. It's still in an uptrend, but it's been seeing a little bit of weakness as of late. The FANG index, which is Facebook, Amazon, Apple, Netflix, Google, and a bunch of other stocks, we've really been chopping sideways here, but we're still above these longer-term moving averages. The financial sector was down a little over 0.5%, but is still in an uptrend. The dollar ended up declining, but we're above the moving averages here, and we've seen a recent golden cross. That could pressure stocks. Here's a longer-term look where we broke out above this longer-term trend line, but now we're coming right back down to it. Oil did fall down a little bit, but it's still been going up as we're seeing geopolitical unrest in the Middle East. And looking at the S&P and comparing it with the rest of the world, we're seeing a real drop-off in the short term, and we're flat to slightly declining with our longer-term correlation. We did come down with the 10-year yield, so that means we went up with the 10-year based on price. And then looking at our growth to value ratios, a little bit of an improvement with the Qs to S&P, but we're still below a declining moving average. We also turned up with discretionary to the S&P, but not above the moving average, and the moving average is still going down. We declined a little bit when we compare large cap growth to large cap value, and the moving average is declining. So with the large caps, we're coming back up to the moving average based on this measure. A little bit of an improvement, but still below the moving average with the mid caps. Also a tick up with the small caps, but below the moving average. We're continuing to decline with our staples to S&P 500 ratio, which typically will give support to stocks. We're just not seeing an awful lot of that right now. So what's our outlook for Wednesday? Earnings season will begin later in the week with the banks coming out first. So the markets are really anticipating that. We're still positive, and I can't change what conclusion we came to after Friday. We're still at a tipping point. There are positive things that you can latch onto. There are negative things, and the market is really apprehensive right now. We're going to get CPI, wholesale inventories, and then the meeting minutes will be coming out at 2 p.m. Eastern. And then we want to keep an eye on all the crazy things going on. Now that the eclipse is over, there's other things that we can focus in on just to keep watch on anything weird that can happen. We will get PPI on Thursday. We're going to get consumer sentiment on Friday. And here's all the different CPI, different reports that will be coming out. There's also going to be a 10-year note auction. There was an auction on Tuesday. Was that 5-year, 2-year? It didn't go very well, but the 10-year is more the benchmark, and sometimes the market may react to that. Seasonally, we are neutral to positive with the Dow, where we're flat out positive with the S&P and NASDAQ. So we have that going for us on a historical basis. And when we look at during an election year, we do see the green dashed line here, a little bit of positive seasonality, but be aware, this is also sometimes when we see some weakness after this. And this is another look that Jeffrey Hirsch posted, where instead of comparing it to the black line, which is usually when the sitting president is running for re-election, that's what we were following. He changed this a little bit, and so now we're just looking at the top first quarter during an election year, and we're getting a little closer to what's been happening. Now, if we are still following that, we could see some weakness until we get later into the month of April. And we're not really following this right now. I just keep showing this chart, wondering if we're going to come back to it. But Wednesday tends to be the most negative day of the week. So that is something negative that we have to deal with. And we do see a little bit of a decline here going into about the middle part of April before we see strength later on. And this is looking at seasonality, where year to date, now we are coming down just a little bit here, but we've been really outperforming other years. April is positive when you look at inside the US. It's also the most positive month when you look at across the globe. It's also positive when you measure it many different ways. And it's up 11 out of 18 times, down 7 out of 18 times. Usually we're up 71.6% of the time with an average return of 1.5%. Tom Bowley also suggests that we're still in a positive time for April. Then we'll hit some weakness. Then later in the month is when we see some strength. So the warning signs, the equity put call ratio based on 5 periods, that's going up, and that's more negative. The parabolic SAR is negative. The bullish percent index is still dropping below 70. It ticked up a little bit, but the moving average is still coming down. The chicken money flow and the chicken oscillators are negative. The ultimate oscillator is negative. The Copic curve is negative. And now I've taken this off the negative divergence area, and our oscillators are now looking more negative, and they're declining after they were giving us extreme readings for much of 2024. Small, mid caps, and large caps, when you look at their growth to value ratios, they are weakening. They're just not showing much strength right now. We still are seeing a negative divergence between the small caps and the S&P. Discretionary to staples, when we look at that ratio, it's also diverging from the S&P. The transports, that's longer term, also diverging from the Dow and S&P. And the momentum for the NASDAQ 100 continues to be negative. Positive sign, the bullish percent index for the NASDAQ 100 has crossed back above 50, so that's turning more positive. The vortex is positive, but it's drifting, even though it's just not showing a lot of strength right now. Large cap growth for right now is holding up, and the financial sector is positive. So our conclusion, I can't really change this for right now. We're not really seeing any material differences coming in, so we're at a tipping point, but we're still positive. In the short term, we do look vulnerable. There is some weakness coming into the market, and that may need to play out for a little bit, especially if we see negative reaction to CPI. In the short term, we're positive, but showing more of a mixed environment. Intermediate term, we're still above overhead resistance. We're still positive, but we're seeing mixed signals right now where we're more positive in the longer term. So that's holding up for right now. We're above the 200-period simple moving average. In fact, we're way above the 200-period simple moving average. And so that is why we're extreme positive and can be considered to be overbought. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.